Good evening, guys. Welcome back to today's class. All right, so today again we are going to see MCQs. Today's the MCQ sessions, right? I think we had a long break, I guess. So to warm up, we'll do certain sums, certain questions. We'll solve certain questions. Then maybe in later sessions we can go on ahead with theoretical portions. All right. I hope the MCQs will help you a lot to understand, and even you will be, used with the questions. All right, so that's the reason. All right, we'll go ahead now. So first one, it is again, this is the question from AS2. Again, I'm repeating the few questions because those are all very important and vital in those particular standards, and that's the reason for rehydration. I'm just given in different kinds. Like, first time you'd have solved it in a way of numerical manner, and now we are going to solve it in a theoretical in the sense only in the sentences. We don't have any numbers here, but we will be doing it as a provision itself. You're getting it. Earlier I would have given like this is the cost is equal to 10, NRV is equal to say 9. Now what is the value of the finished goods? What would be the valuation of the raw material? So you would have say whether it is cost or NRV, whichever is the lower one, so you'll choose accordingly, right? So the same way here, this is the same provision again, but we are going to solve it in a theoretical way. All right, so the first question what it asks is, if finished goods are sold at or above the cost. Remember, this is not about the valuation of finished goods. All right, remember it starts with finished goods. No, please remember, if finished goods are sold at or above the cost, then raw materials are valued at. So now the provision here you have to remember is valuation of your raw material, because inventory is divided into three categories. One is raw material, one is WIP, work in progress, and one is finished goods, right? So the provision remains same for these two things, and there is a separate provision for raw material. Under raw material there are two, it is like a sub provision, I will say. Usually raw material will be valued at what? It will be valued at their cost. Correct, no? Usually it will be valued at their cost. But what happens? Suppose if the finished goods, if it is sold less than its cost though, then valuation of raw material will be at its real replacement cost. Correct, na? All right, replacement cost or realizable, not realizable, replacement. Realizable will come only for these two things. For raw materials, it would be replacement cost. All right, so raw material will be valued at cost usually. Suppose if the finished goods are sold at a price lesser than its cost, then raw material will be valued at its replacement cost. So there is one if condition there, right? So now you have to remember that if condition. Now you have to answer. So what they have given, if finished goods are sold at or above the cost, so which means it is a normal situation. So in normal situation, raw material will be valued at its cost. Raw material will be valued at its cost. Here the option is wrong, guys. It would be valued at its cost. All right. So now, ma'am, if it is less than the cost, if the finished goods are sold at less than the cost, so then what will happen? Then it would be at its replacement cost. Just a minute, guys. I'm connecting to your, chat box. 1 minute. I'm just connecting here. I'm just connecting, just a minute. All right, it is connecting. Let me see whether is there. All right, so we'll go to the next question. So you understood now. Please remember, Raw materials will be valued at its cost in generic situation, in general situation, provided if finished goods are sold below the cost, then raw material will be valued at its replacement cost. You're getting it? All right. Next question. Mr. X accounted 2 lakhs as dividend, and this question is relating to your AS9 revenue recognition. All right, now we'll read the question. Mr. X accounted, just a minute, now I got the link. I'm just going ahead. 1 minute. Yeah, I got it. All right, now I can see. All right, yes. Now coming back. So Mr. X accounted rupees 2 lakh as dividend on 31st March 2020 for the financial year 1920 on accrual basis. Please remember, X accounted 2 lakh as dividend on 31st March. So financial year 1920. So 31st March itself, he just accounted 2 lakh on accrual. The dividend for the said year was declared by the company on 20th September 2020 for 3 lakhs to Mr. X. Then what will happen? Please remember, Mr. X, he thought that he will receive 2 lakhs as a dividend, okay, for the financial year 1920. All right, what he thought is, okay, fine, I will receive 2 lakh as dividend because accrual basis, which means he didn't receive it. He just accrued. He just assumed that he might be receiving 2 lakh for this financial year. So what he did on 31st March itself, he passed one journal entry, which means he accrued the revenue. Now the question is, can he do so? Can he do so? The answer is no. He can't do. Why? Because AS9 clearly states that dividend will be booked only when the recipient establishes the right to receive the dividend. You are getting it. It is not, you cannot just like that book as on your assumptions, you cannot accrue the dividend income. The dividend income can be recognized in the books only when the shareholder, only when the recipient establishes the right to receive the dividend. Ma'am, what does it mean? Establishes the right to receive. Establish the right to receive means when the company declares the dividend, then at that point, the recipient, the shareholder, is eligible to receive. He has the right to ask now. You are getting it. This I have told you, even in your Companies Act also, it has been told that once the dividend has been declared by the company, there is no way for backing out. There is no way of revoking it. It has to be paid to the shareholders. Correct. So based on that, even AS9 says that, so the shareholder, the recipient, because who will receive dividend, guys? Only shareholder will receive dividend. No. So I'll use the word shareholder. All right. So the shareholder should account such dividends in their books only when they establish the right to receive. So when they will establish, when the company has declared, in that year only, they have to record this revenue, irrespective of the year for which the dividend belongs to. Please remember. So for example, now in this case, what happened? Mr. X assumed he will be receiving 2 lakhs for this financial year, and he accrued it in this year itself. This provision, this accounting treatment is wrong. You are getting it. Why? Why? Because the company declared dividend when 20th September 2020. Which year they have declared? 2021. Correct, financial year 2021 only they declared. Then this year only, Mr. X should recognize entire 3 lakh rupees. Should recognize entire 3 lakh rupees. In this option, nothing is correct. 1 minute, 3 lakhs will be booked in the financial year. This is correct, guys. It's not E, it is C, sorry. 3 lakhs will be booked, it's the typo error. 3 lakhs, the entire 3 lakhs will be booked in the financial year 2021. Please remember that. So he cannot book 2 lakhs and all in as an assumption accrual basis. He cannot book. So this is wrong. It is not according to AS9. So he has to book it in the year 2021 because he received only when in the year when the company declared it. 20th September 2020, which means it falls in the financial year 2021. So the entire 3 lakh will be booked, will be recognized in the financial year 2021. You are getting it? Remember, see here, as per AS9 states that dividend from investment in shares are not recognized on the P&L until the right to receive dividend is established. In this given case, the dividend is declared on 20th September 2020. So, right to receive dividend on established which year? 20th September 2020. Therefore, on applying the provision, the income from dividend on share should be recognized by Mr. X in the financial year when? 2021 only. You're getting it? Whatever he has done is wrong. You are remembering it? All right. So the answer is C. The entire 3 lakhs should be recognized in the year 2021, and what Mr. X has done is wrong. You are getting it? All right. Next one, financial statement includes. Guys, this is a theoretical portion. Ma'am, we know that. So here, there is one small change because Companies Act also got amended. And in Schedule 3, they states that balance sheet, P&L, in that what happened? They added this word, statement of changes in equity. Actually, earlier what happened, this one forms part of the explanatory notes basically. But now, I mean, now in the sense, last, 2-3 years, what happened? They started giving this as a separate, disclosure. You are getting it? So now we are saying statement, this one is a separate, disclosure, separate, like how we prepare cash flow statement, the same way we will be preparing even changes in the equity also as a separate statement. So now when I say financial statement, it means it includes balance sheet, P&L, cash flow statement. You know that explanatory notes. Along with that, please add statement of changes in equity. Even all these things will be considered as financial statement. You are getting it? All right. Next one, intrinsic value. This one you will come across in ESOP, employee stock option scheme or stock option plan or employee benefit, whatever it is. Under this chapter, you will be coming across this term called intrinsic value. Intrinsic value means your excess of your market price. All right, excess of your difference between market price and your exercise price, that would be your intrinsic value. So what does it mean? Whenever the company declares the options, all right, whenever the company grant the option, at that point, what was the market price and at what rate the company allows its employees to exercise their options. That is called exercise price. So the difference between these two is called intrinsic value. The difference between these two is called what? Intrinsic value. So excess of market price over the exercise price is called intrinsic value. This is the definition. So the formula is MPS minus exercise price will be called as intrinsic value, and this will be amortized over the life of the option. You're getting it? So this one you will come across your ESOP chapter. All right, 1 minute. Let me, I think I am live, I believe. All right, because I think, is there any network issue, guys? I don't know. All right. Let me go to the next question. All right. So the exchange difference arising. Again, this question is on AS 11. This question is on what? AS 11. Remember, guys, please, if you feel that I am fast though, I'll go slow. All right. Now, the exchange difference arising on reporting long-term foreign currency monetary item. Now, each and every word is important. You're getting it? Each and every word is important. Please remember in AS11, there are currency, monetary item, non-monetary item, long-term, foreign currency monetary item. You're getting it? So you should be very careful while you're reading AS11 ka provisions. I already told you AS11 is quite big when compared to all other standards. First one is PPE. The biggest one is PPE, AS10. Next one is AS11. All right. Now remember, when you are adjusting or when you are reporting a long-term foreign currency monetary item, in what? In the subsequent year, which means the event has happened in some year and you are reporting that in the next year or subsequent years. All right. In relation to the acquisition of depreciable asset. Please, ma'am, so many things are here, ma'am. Guys, this is nothing but there is a provision in AS11. What it says, suppose when you took, all right, when you took a loan, I'll tell you a example. It is an option given to the companies under a Companies Act, all right. So what they say under AS11, what they say, there is one paragraph 46. It says that suppose if you purchase a depreciable asset, all right, if you purchase a depreciable asset and you purchase this asset in foreign, maybe in foreign currency, or you took a loan to purchase this asset in foreign currency. Okay, so what happens? Suppose I placed an order for the asset, say in US. All right, the asset value is say 10 million. Now I'll tell them that 10 million I cannot pay immediately. I will pay in, you know, in 5 installments in 5 years time or 7 years time or 3 years time, like that I'm saying. So now what happens? I will get the machinery at the same point and I'll get the asset at the same point. I have a loan for that because I didn't pay. No, there is a creditor for me who is in the foreign country. You are getting it? All right. Or suppose what happens, I may purchase the asset in India only. That machinery would be from India, but to finance that, I would take loan from outside. Now I will go outside and I'll ask, sir, I need money to buy this asset. Could you please give me money for this asset? So now they will lend me money. So you're getting it. So at last, this foreign currency transaction, what you are doing, it is related to a purchase of a capital asset, depreciable capital asset. Remember, so the whatever the foreign currency transaction you are entering now is related to what? Purchase. Related to what? Purchase. You are getting it? Purchase of a capital asset. Purchase of a capital asset. Depreciable capital asset. That is important. You are getting it? Depreciable capital asset. Right. So now what happens, say for, I'll tell you with an example so that you can understand this theory. All right. What happened in the year, now we are standing in 22-23. All right. Now 21-22, what happened? I will keep it simple. $1 lakh. Okay. The asset value is $1 lakh. Now I said I will be paying this in 5 installments. Yearly. So which means what? $20,000 each year I have to pay. Correct? So now 21-22 I paid. First installment I paid, I took the machinery. Now in my books what happened? That machinery will be $1 lakh. All right. Now that suppose I purchased from say Mr. X in USA. Now Mr. X, I'm supposed to pay how much? For me, here it would be how much? 80,000 rupees. 1 lakh I'm sorry, machinery. It is in INR, no? So $1 lakh though, suppose as on March 31st, I place that order. So as on March 31st, we'll keep it simple. So 70 rupees. $1 is equal to 70 rupees. Now machinery will be 70 lakhs here. All right, machinery will be 70 lakhs here. Now, X I paid already $20,000. Still how much I'm supposed to pay? $80,000. All right. On that day, how much it was? 70 rupees. All right. So now 8 sevens are 49, so it would be 9 7 8 are 56. Correct, no? Right? So now it will become 56. So 56 lakhs, I will be recording it. Mr. X, I am supposed to pay 56 lakhs because $20,000 I already paid. So 56 lakhs I am supposed to pay, and 70 lakh machinery was there in my books. So this is the status. This is as on 31st March 2022. All right. Just a minute, just a minute. No. I'm sorry. Just a minute, guys. Just a minute. Yeah, I'm sorry. I just clicked on this one. I'm sorry. So now 31st March 2022, machinery is 70 lakhs. Whereas creditor, I'm supposed to pay 56 lakhs. Correct? All right. So how we got it? 1 lakh is the loan amount, $1 lakh. Out of that 20,000, I first installment I paid. So baki $80K multiplied by 70 rupees INR I converted. All right. So 8 sevens are 56. I just put. All right. Now, next comes next year I will be paying, right? So 31st March 2023. All right. 31st March 2023. Now I would have paid 20,000 again, right? So machinery will still be, 70 lakhs. Now I will be paying him $20,000. So now when I go to the bank, 31st March 23, now the dollars were appreciated. So now it becomes 80 rupees. $1 is equal to 80 rupees. Now what happened, guys? 20,000. All right, I paid it to him. 20,000 I paid to him, but at that time it was 80 rupees. You are getting the point. Now what happens? I have to reinstate. Now 20,000 I paid. Now baki how much it would be? There is an increment. While at the time of booking it is 70 rupees, but now it has become 80, which means there is a 10 rupees exchange difference which I am going to bear, or I have to pay. You're getting, no, I'm going to incur. If I would have paid it in the last year itself, I would have paid at 70 rupees. But now I am paying 80 rupees for the same value, which means 10 rupees I am going to pay extra. So it is a loss, no? It is a loss, no? Because subsequent year it is happening for me. Correct, no? I have to reinstate, right? I am paying one side. But baki, ma'am, you are paying only 20,000, ma'am, but baki 60,000 is still. But I have to reinstate. No, on that day my liability was at 80 rupees. No, correct. No, at that day my liability was at 80 rupees. Correct. No. So now what happens? There is an incremental in the liability which I need to pay more, which means it is a loss to me. Right. So now what they are saying, so this exchange differences, you can instead, what will you do, guys? You will say that, okay, it is a loss. I have to charge it to P&L as a Forex loss. So now what this provision says, 46 paragraph says, you're right. What it says is, no, Baba, suppose if you, 46 and 46A will say that, what it says, suppose if this liability is towards a purchase of a depreciable capital asset, any exchange difference ka impact, all right, any exchange difference ka impact while reporting in the subsequent year, that you can adjust straight against the cost of the asset itself. You no need to charge it to your P&L. You no need to charge it to your P&L. Rather, you just adjust the same thing with the cost of the asset. Ma'am, what does it mean? Here what happens, I will not charge that 10 rupees extra because at the time of booking it is 70. Now it has increased to 80, which means there is a 10 rupees excess, which means it's a loss to me. So it is a loss. So what will happen, guys? It is a loss. So I have to debit. I have to debit the P&L. Instead of debiting the P&L, you debit the asset. You add to the cost of the asset. You are getting it, that exchange difference. Ma'am, but this is notional. No, suppose next year while I am paying, while I'm reporting, while I'm paying it, it has now rupee value has appreciated. It has come down to 60 rupees or something. Then no problem. It is a profit. Correct. No, your liability has reduced because of what? Because of your exchange difference. Then adjust the same amount with your cost of the asset. Reduce it from the cost of the asset. That's it. So if there is an incremental in your liability, then add it to the cost of the asset. If there is a decrease to your liability, then minus it from the cost of the asset. That exchange difference, because of exchange difference, if there is any incremental in your liability, foreign currency liability, long-term liability, because of purchase of an asset, then add that exchange difference to your cost of your asset straight. Don't charge it to P&L. Don't charge it to P&L. If there is a decrease, then minus it from the cost of the asset in the next year. So no need to give impact in your P&L. So this is a theoretical question, and this is from your AS 11, and this is important. This is as per 46, paragraph number 46 and 46A. This is an optional, so the company wants to follow, they can follow this. You're getting it? All right. So please remember, ma'am, suppose it is not a depreciable asset, then what they can do? They can open a separate account called foreign currency monetary item translation difference account. All right. We call that as FCMITDA. All right. So they can open that account and they can charge, instead of charging it to P&L. Ma'am, why we are not charging? Guys, please understand. If I charge everything to P&L, it is, again, it is notional. Okay. I mean, it is not on the entire liability. Only to a certain portion I'll be incurring next year. Again, if there is a appreciation in the rupee value, then again I'll be enjoying some, profit there or benefit there. You're getting it. So what they are saying, this is not a real gain. This is not a real gain or loss until you pay it or until you literally make the payment. So but provision says that you have to what? You have to report correctly. You have to reinstate every financial year. Right. So at that point, don't hit that the P&L. Why? Why? Because unnecessary it is a hit. No, your P&L is juggling because of this, which is not real, or which is very much notional in the way. So what I say, why you want to hit the P&L? So if it is related to a depreciable asset, please hit the cost of the asset itself. Hit the asset account, because anyway the asset is depreciable. So the original cost of the asset will be depreciated. All right. If there is any addition, that will also get depreciated over the life of the asset. If there is any reduction, that will also be depreciated along the cost of along the life of the asset. That's it. So it is very simple. Don't touch the P&L. You're getting it? All right. So remember, if it is related to, if your long-term foreign currency monetary item is related to your purchase of a depreciable asset, and in the subsequent years, if you're reporting it, and if there is any exchange differences, that will be adjusted against the cost of the asset. You are getting it? Remember, this is under AS 11. All right. Next question. When PPE is, this is AS10, this is AS10 PPE. When PPE is retired means the PPE is not used actively, which is not used for your business anymore. Retired, it's a literal meaning. So retired from active use and held for disposal, which means it is like a scrap basically. All right. So now I'm just the PP, that particular equipment or machinery, I'm not using it. It has done its service. That's it. Now the asset is no more required. Now what will happen? How will you show that? How will you carry that asset in your books? It is a definition oriented. It's a provision oriented question. So it clearly says, AS10 clearly says that when a PP is held for disposal, or when it is retired from active use, then it should be carried. All right, it should be valued at its carrying amount which is shown in the books, or net realizable value, whichever is lower, whichever is lower. Remember, suppose so far in my books I was showing it as 1 lakh, but right now if I put it for scrap, I will get say around say some 20k. Now what I should do in my books, I should show only 20k. I cannot show it as 1 lakh. No, because whichever is lower. Remember, guys, this is a matter of prudence, because that asset is no more you wanted and you are not going to use it. You are just keeping it aside because it is retired from use and you are planning to discard it because it is held for disposal. Now tell me, simply can you put that carrying amount? Suppose you carry that at the original cost you purchased for 1 lakh 10 years before. Now also I will show like that. Does it make any sense? No, right? So what I am saying, fine. But please compare that with your NRV, net realized. Right now, if you discard it, what you will get? So you check with that NRV. So whichever is lower, you consider that. You have to value that. You have to make sure that that is reported at its carrying amount or NRV, whichever is lower. Ma'am, suppose then what will happen to the accounting entries, ma'am? You said it is 20k I have to show. Now 80k, there is a reduction. Or charge it to P&L. It is a write down, right? Write off, basically. Correct. My asset has been written off. Written off means useless. 80,000 is useless. Now I will park it to P&L as a charge. Charge means debit. Expense, loss. You are getting it? So 80,000, I'll write it as a write-off of an asset 80,000 and I will show that asset in my balance sheet at rupees 20k. That's it. You are getting it? So please remember, this is from AS 10. PPE. So whenever a PPE is retired from its active use and it is held for disposal, then it has to be shown in the books at its carrying amount or NRV, whichever is lower. You are getting it? All right. Next question. Again, this is a simpler question. Which schedule asks you to prepare the financial statements under Companies Act? It is Schedule 3. If they ask about depreciation, then it is Schedule 2. Remember, Schedule 3 talks about the preparation of your financial, how your financial statement should look like. Look like in the sense what and all will come under balance sheet, what and all will come under P&L, what and all will come under cash flow. Everything has been told under Schedule 3, all right, of Companies Act. If they ask you depreciation, then it should be at Schedule 2. I told both the things. Remember, Schedule 3 is for financial statement, Schedule 2 is for depreciation. You're getting it? Both the steps are given in Companies Act. All right. Next question, working capital. This question is from your ratio analysis. There is a chapter in your syllabus called ratio analysis. There this kind of question will come, or even in your funds flow also it will come. All right. Funds flow also you will be seeing this kind of questions. So remember, working capital is 7,50,000, current liability is 4,80,000, then the current assets would be. First of all, working capital means what? Excess of your current assets over your current liability. That is a definition. Remember guys, current means what? Short term. Basically, see, working capital, if I want to put in very colloquial local language, how much I need to run every day ka operations. You're getting it? That is called working capital. That's it. All right, how much I will be needing to run. I'm not talking about my existence. I am not talking about my server. Please remember. See guys, solvency is different. Working capital is different. Ma'am, what is that solvency? Guys, remember, solvency means long term I'm talking about. Right now, every day I have to. See, you'll be saying, no, first let me talk about today, will I cross tomorrow? So it is like that. Working capital is like that. 50 years it is my down the line, this is the growth rate, that is solvency. You're getting it? So which means I can sustain for a longer period. I'm not talking about that. Working capital means every day what is required for operations, every how much I will be needing to run the day-to-day operation. That is called working capital. Working capital, you remember? So what is the formula for that? Working capital is equal to current asset minus current liability. This is the formula. Now it's a XYZ sum only. So working capital, they have given 7.5 lakh. Current asset they are asking. So I'm just keeping it as CA. Current liability is 4.8. Now the current asset would be how much? 7.5 lakh plus 4.8 is equal to current asset. That's it. So the answer is 12 lakh 30. It's just the XYZ. You need to know the formula. That's it. So you need to know the definition. If you know the definition, if you know the formula, you can answer these type of questions. All right. Now, if the current assets are lesser than current liability, then what will happen? It is related to the previous question. Remember, current asset minus current liability means it is working capital. That is the formula actually. Here, current asset is lesser than, which means current liability is more though, then my working capital is negative. I need more funds. I am not in the position to meet the everyday operations because I don't have sufficient capital. You're getting it. So which means it is working capital is negative. It is negative. You're getting it. You need more funds. You're struggling then, which means you're struggling. You're struggling to meet your everyday needs itself. You're getting it. That is a sign. You're getting it. If any organization whose working capital is negative, which means I am struggling. I am struggling to meet my own, own working needs, own operational needs. I will be breaking the capital very soon. You're getting it. All right. So remember, my capital is eroding. Yeah, so working capital is negative. Remember, these are all to analyze the situation of the companies, guys. So these type of analysis will help you to understand about the performance of the company. How well the company is performing, are they good or are they in very bad shape? So these are all basically questions from your ratio analysis, or you can say that analysis of your financial statement. By reading the financial statement, what you will understand, what you will interpret. You're getting it? So this is a kind of interpretative question. You're getting? All right. Next one. If revaluation of an asset has to be done, then it has to be done on entire class of the asset. This we have seen even earlier also. All right, please remember, it is not that I can do it only for one asset and I can leave. No, entire asset class I have to do it. Yeah, I'm not spending much time on this because we have spent so much time on this question. Again, this is from AS10 PPE. All right, now this is again an interpretation question. When a company is called as solvent, remember, solvent means I am good. I am good enough. All right. I am good enough. I can sustain. You're getting it? I can sustain for a longer time. Yeah, I can sustain for a longer time. So no worries on that. So now, when will I say that? When people will say long-term asset, no. My total asset should be greater than my total liability. Then I am safe. I am sound enough. You're getting it? So remember, total asset, when total asset is greater than total liability, a company is called as solvent, because I have so much that at any point of time, if all the creditors, they are asking me money, I can be able to meet all those obligations. All those obligations. Why not, ma'am, current asset? Guys, current asset is just for liquidity. It does not right now, but in future, in long term, how will I be? Where I will be placed? So for that, your answer is solvency. So when my total asset is greater than my total liabilities, at that point, I will be very much solvent. If it is ulta, then I will become insolvent, which means I'm not able to meet my liabilities. My assets are not enough to meet my liabilities. I'll go bankrupt. At that point only the bankruptcy will come into picture. You are getting it? If this is ulta, then the answer is bankrupt. You are getting it? All right, you are bankruptcy there. You are entering into a bankruptcy there. Yeah, so when will be a company called solvent? When your total asset is greater than total liability. Suppose in your question, if they are asking when a company is sound enough in liquidity, then current asset is greater than current liability. If you're talking about liquidity, then I will go with current asset. If you're talking about solvency, I have to go with total assets. You are getting it? All right. Next one. This is not directly related to your ratio analysis, but this is like, in a formula, there is one component. So to find that component, we are doing this sum. All right. Now, advertisement expenses are 1 lakh, gross profit is 2 lakh 20, wages 80, sales 4 lakh. Net profit ratio would be. So, first of all, what is the net profit ratio formula? Net profit ratio formula is net profit divided by sales into 100. Okay, net profit by sales into 100. This is the net profit ratio ka formula. So now you have sales figure. Yes. Do you have net profit figure here? They have given only GP, no, gross profit. So they didn't give net profit. Now you need to find out first net profit. You need to find out what? Net profit. Then you need to apply the formula. So now, ma'am, how do I find out net profit? Guys, it is very simple. Gross profit minus all indirect expenses will give you net profit. Now you have gross profit in your hand. They have given that it is 2.2 lakhs. Now you need to find out what are all my indirect expenses. Now in this question, they have given you two things: advertisement expenses and wages. Remember, wages is a direct expense. It has been already captured in your GP. All right. So don't take this. Advertisement expense is the indirect expense. Now I will be taking it minus 1 lakh. So now 1.2 lakh is my net profit. Now how will I find out ratio? Net profit divided by sales into 100. If I put it as net profit ratio is 30%. Ma'am, how do I know whether it is direct expense or indirect expense? Please go through the fundamental notes which I gave for accounting, basics of accounts. In that, everything we have explained. You are getting it? All right. All right. Yes, the next question. 1 minute, guys. Just a minute. All right. No, this thing got disconnected. 1 minute. Yes. Yeah. Now I got it. All right. We'll see the next question now. Dash is the residual interest in the assets of the enterprise after deducting all its liabilities. Remember, guys, this is a definition oriented question. All right. These things are given in your basics of accounting or accounting terms and introduction to financial accounts. In all these notes I have given. Guys, what happened? This is very basic question. Why I have given here is suppose there is one chapter, there are not one, there are two chapters in your syllabus. Basically, one is like financial statement, and one is like a preparation of financial statements, and their framework, the framework. So there basically every definitions will be covered. You're getting it. So when I talk about framework, it talks about what should be the current asset, what should be the non-current asset, what and all should be under the current liabilities. So you need to know the definitions of those things. So when I say statement of changes in equity, then what is meant by equity you should know. Correct, na? When I say a provision, what is meant by provision you should know. So these are all definition oriented questions. Because in those two chapters, it is very much theoretical, and it is very much, into what I can say, into the basics, or not, definitions basically. You're getting it? It is more into that. So that's the reason I have given these type of questions. This is related to your framework, I can say. This is related to your basics of accounting or financial accounting or financial statement, I can say. So here there is a definition for each and every terminology. As at least you should know the definitions for balance sheet equation. I hope you guys remember. Correct? Assets is equal to liabilities plus equity, or equity is equal to assets minus liabilities. At least you should know definitions for these things. So now the definition here is dash the residual interest in the assets of the enterprise after deducting all its liability. What is it? Nothing but equity. Assets minus liability, what is it? Equity. The answer is it's formula, that is theory. That's it. So the answer is what? Equity. I hope you guys remember these things. All right. I hope you find all the questions useful. Right. Now let me solve one more question. So cost of raw material is ₹5, conversion cost is 4, selling cost is 2, then the cost of inventory would be, remember, cost of inventory means it includes, we studied that, right? Cost of inventory is nothing but it includes all the purchase cost, all the conversion cost, all right, all other cost, including how much it, if it is related to storage, everything, all those things, right? So now in this, we never talked about selling cost. Selling cost is not part of my inventory because that comes after production, just it is out for market. So there I will incur. So cost of inventory won't include selling cost. So now cost of inventory would be how much now? 5 plus 4, 9. So this is coming under AS2 inventory valuation. You're getting it? I hope you are getting all your questions, guys. All right. Now, next question. X Limited purchased 75% of shares of Y Limited. Remember, if any company purchase more than 50%, then it will become a subsidiary. Correct, na? So subsidiary, though it is a long-term investment. Remember, each and everything is important here. When I purchase somebody's shares of 75%, which means if it is more than 50, then I'll become its owner. Right? No? Then that person will become my subsidiary. So subsidiary, though today I'll buy, tomorrow I will sell. No, right? Subsidiary is for long term. All right. So now they purchased for 45 lakhs. Fine. The current MPS of the same share came around 52 lakhs. Now what will I do? I will show it as a 52 lakhs in my book. No, long-term investments will always be carried at its cost. Unless otherwise, if there is any permanent reduction in its value, the cost will not be changed. If it is a short term, then my answer would be different. My answer would be different. But if it is a long-term investment, then you have to carry the investments at its original cost. Whatever the market price, irrespective of the market price, I'm not bothered about what it is. If it is a long-term investment, it should be carried at its cost. So the answer would be 45 lakhs. All right. Hope you are getting. This is under AS 13, investment valuation. Long-term investments will be carried at its cost unless otherwise there is a permanent reduction in its value all the time. If it is a short term, then the provision is different. You are getting it? Hope you guys are getting all these things. I hope you find all these questions useful, guys. All right. I'll see you on the next class. I wish you all the best for tomorrow. Have a great day tomorrow. Good night.